The core paradox is self-evident. The United States, holding a national debt exceeding 34.5 trillion gross, finances a trade deficit often in excess of 800 billion annually, yet maintains global borrowing costs lower than almost any developed nation. This is not economic magic. It is a structural subsidy. Since 1974, the petrodollar system ensured that nearly 80% of all global oil transactions required the US dollar, forcing every nation to hold vast quantities of the currency. This manufactured demand created the exorbitant privilege, the ability to print money, export it for real goods, and have foreign nations reinvest the surplus, the petrodollars, into US Treasury debt. The system provided America with cheap capital and perpetually low inflation. The end of this implicit 50-year agreement, signaled by major oil producers negotiating non-dollar settlements, removes the single largest pillar of structural demand for U.S. debt. This is the financial historian, where money, power, and history collide, and nothing is ever as simple as it looks. The cost of a perpetual deficit is about to be repriced. To understand this, we need to start earlier. The petrodollar system was a direct, calculated response to the collapse of the Bretton Woods architecture. On August 15, 1971, President Nixon unilaterally ended the convertibility of the US dollar to gold. This Nixon shock instantly de-linked the dollar from any commodity backing, transforming it into a purely fiat currency backed only by the full faith and credit of the US government. The dollar's value immediately plummeted against other major currencies, threatening its status as the world's primary reserve asset. The global financial system faced a crisis of confidence. Concurrently, the geopolitical landscape was fracturing. The 1973 Yom Kippur War led to the Arab oil embargo, quadrupling oil prices from approximately $3 to $12 per barrel. The newly wealthy oil-producing nations, primarily within OPEC, were receiving payment in a now unbacked depreciating dollar. They demanded a stable store of value for their suddenly massive oil revenues. The numbers told a different story. The United States, through Secretary of State Henry Kissinger and Treasury Secretary William Simon, engineered a strategic pivot. Starting with Saudi Arabia in 1974, a series of tacit, high-stakes agreements were struck. The core of the deal was simple and devastatingly effective. Saudi Arabia would agree to price all its oil exports exclusively in US dollars, and critically, would recycle the majority of its surplus petrodollars into US Treasury securities and dollar-denominated assets. In exchange, the US offered military protection for the Saudi monarchy and guaranteed access to American arms and technology. This agreement was the real shift. This created a self-reinforcing financial loop, the we need oil demand, dollar demand nexus. Every nation, whether France, Japan, or Brazil, that needed oil for its industry had to first acquire US dollars. This artificial, non-cyclical, and continuous demand for the dollar maintained its value and liquidity in foreign exchange markets, far exceeding what the size of the US economy or its trade balance would naturally dictate. The second half of the loop, the petrodollar recycling, was the fiscal subsidy. When Saudi Arabia and later other OPEC members reinvested their massive dollar surpluses, hundreds of billions annually, into U.S. Treasury bonds, they became the largest foreign financiers of the U.S. government's budget deficits. This constant, enormous bid for U.S. debt kept interest rates artificially low for the U.S. government and, by extension, for American consumers and corporations. Confidence became currency. The U.S. gained the exorbitant privilege. It could finance its vast trade deficits by issuing debt denominated in its own currency, knowing there was a guaranteed foreign buyer. This financial arrangement permitted decades of simultaneous guns and butter policies, massive military spending, and expanded domestic programs, without the corresponding inflationary or interest rate penalties that would cripple other nations. By the 1980s, the system was fully structural. Oil prices, energy consumption, global reserve management, and U.S. fiscal policy were all intertwined. The share of U.S. dollars in global official foreign exchange reserves consistently held above 60%, a financial supremacy that transcended the decline of U.S. manufacturing. The numbers spoke clearly. The financial advantage was worth trillions. This structural mechanic allowed the U.S. to operate with a financial latitude unavailable to any competitor. The price was not paid by the U.S. government, but by the global financial system, which was forced to accommodate the dollar to secure its energy needs. This was a clinical financial architecture. The world effectively paid a hidden tax to the U.S. Treasury to keep its lights on. The modern mechanics of the system are colder, sharper, and deeply institutional. The petrodollar system has never been about oil. It has always been about liquidity dependencies and power asymmetries. The key today is that the dollar is not merely the currency of oil, but the currency of clearing, the infrastructure through which most global commodities, trade finance, and derivative contracts are settled. This is where the structural leverage lies. The system currently works through forced non-commercial reliance. A country like Germany buying oil from Norway, or South Korea buying LNG from Qatar, still requires dollars to facilitate the transaction, even if neither country is the U.S. The U.S. commercial banks, such as J.P. Morgan Chase and Citigroup, control the choke point, the clearing of dollar payments through the U.S. financial system. This gives Washington a devastating crisis trigger, the ability to impose sanctions and freeze assets by cutting off access to the dollar clearing infrastructure. The recent case study of Russia's frozen foreign reserves, over 300 billion won, demonstrated this weaponization to the entire world. This was an institutional action that told every sovereign nation a simple truth. Your dollar-denominated assets, held as treasury securities or bank deposits, are not truly sovereign and can be confiscated on a political whim. The price of this unilateral power is the current global diversification drive. The illusion holds until it doesn't. The consequence is the rise of alternative institutional and currency structures. China and Russia are actively promoting trade settlement in non-dollar currencies, specifically the Chinese yuan, renminbi, and local currencies. China, the world's largest oil importer, has been aggressively pushing the petroyuan, establishing yuan-denominated oil futures, trading in Shanghai, and signing long-term energy contracts with Saudi Arabia, Iran, and Russia that permit payment in yuan. This is a direct challenge to the liquidity dependencies. The petrodollar recycling system is demonstrably weakening. Data from the IMF's KOFR, currency composition of official foreign exchange reserves, shows the dollar's share of global reserves has fallen from a peak of over 70% in 2000 to approximately 58% currently. This decline is not an accident. It is the deliberate policy of central banks seeking to diversify away from geopolitical risk. Countries are accumulating more gold, more yuan, and more non-traditional currencies. Saudi Arabia, historically the central pillar of the petrodollar, has increasingly signaled openness to accepting non-dollar settlements and has deepened its ties with the OIN BRICS economic bloc. The key for the U.S. remains the rollover risk. The U.S. Treasury must constantly refinance its immense debt, often over $1 trillion per quarter. The petrodollar recycling guaranteed a stable base of foreign buyers. As this base erodes, the U.S. faces higher borrowing costs, since it must attract a larger share of domestic or private foreign buyers who demand higher yields. This introduces inflationary pressure, as the U.S. government must either raise taxes, drastically cut spending, or induce the Federal Reserve to effectively monetize the debt. What cannot be repaid will be rolled over, but the cost of that rollover is escalating. The death of the petrodollar is not a single event. It is the slow, grinding institutional shift away from the U.S. financial choke point. The rise of the petroyuan and increasing bilateral currency swaps are symptoms of a financial world decoupling from U.S. geopolitical diktat. Markets enforce what politics avoids. The loss of the exorbitant privilege means the U.S. must now compete for capital like any other nation, which will fundamentally reprice the cost of its massive fiscal and trade deficits. Confidence decides who survives. The final stage of this structural breakdown moves from the institutional challenges to the direct, unavoidable economic consequences for the U.S. economy and the global order. The removal of the petrodollar's structural subsidy translates directly into higher costs for the average American and a recalibration of U.S. global power. The era of the My Free Lunch, funding domestic consumption and foreign military presence with cheap, recycled foreign capital, is concluding. The core mechanism of consequence is the loss of the guaranteed demand floor for U.S. debt. As major oil producers and large trading nations like China, India, and Brazil settle more transactions in local currencies, they require fewer precautionary reserves of U.S. dollars. This reduction in demand for the dollar as a reserve and trade currency weakens its exchange rate and forces the U.S. Treasury to raise interest rates to attract the necessary capital to finance its deficit. With the U.S. deficit approaching 7% of GDP per annum, even a modest, sustained increase in the interest rate burden rapidly compounds into a fiscal catastrophe. Every part of 100 basis point increase in the average cost of debt service on $34.5 trillion. Prior debt is a direct, substantial fiscal drain. This erosion of dollar demand creates two systemic domestic pressures. First, imported inflation accelerates. A weaker dollar means every import, from consumer goods to industrial components and, most crucially, oil itself, becomes more expensive. This acts as a regressive tax on the American consumer, driving up the cost of living and eroding real wages. Second, domestic capital competition intensifies. With foreign official demand for Treasury bonds diminishing, the U.S. private sector must buy a larger share of the new debt issuance. This crowds out private investment, raising borrowing costs for mortgages, corporate expansion, and capital expenditure. The high cost of funding the state's debt displaces productive investment in the economy. Modern case studies illustrate the severity of currency dependence. Argentina, perpetually unable to finance its deficits in its own currency, is forced into cycles of hyperinflation and external bailouts, enduring interest rates exceeding 80%. The U.S. is not Argentina, but the structural principles apply. Loss of external currency demand eventually translates to domestic loss of purchasing power. The rise of a multipolar currency system, where the euro, the yuan, and regional trade blocs utilize their own currencies, fragments the dollar's monopoly. This fragmentation introduces greater volatility into global energy markets, as oil prices must be constantly hedged across multiple currency pairs, increasing transaction costs for all importers. The final and most significant consequence is the shift in geopolitical power. The U.S. ability to impose sanctions and wield financial leverage is directly proportional to the world's need for the dollar. As nations exit the dollar clearing system, the effectiveness of the sanctions weapon diminishes. This forces a strategic pivot away from financial coercion and toward more traditional and potentially more costly military or diplomatic tools. The U.S. is forced to pay for its global presence with its own genuine national resources rather than an implicit foreign subsidy. The system is not ending with a collapse, but with a slow, grinding repricing of the United States' chronic structural imbalance. The cost of maintaining global military supremacy and a high domestic consumption rate, once covered by the petrodollar, must now be paid for in real terms: higher inflation, higher interest rates, and reduced fiscal flexibility. The end of the petrodollar is the beginning of domestic economic constraint. The debt always comes due. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.